On September 10, 2020, a research firm with 9 employees published a 67-page report accusing an electric truck company of being, in the firm's own words, an intricate fraud built on dozens of lies. Footnote 1. The company's founder called it garbage. No regulator had said a word yet. No jury had ruled on anything. The market didn't wait for either of them. The stock started falling within hours. 2 years later, a federal jury agreed with the report. Footnote 2. Here's the thing. That same week, in that same market, some of the most spectacularly overpriced companies in modern financial history were still climbing: special-purpose acquisition vehicles with no revenue, meme stocks trading on message board momentum, valuations that made about as much sense as the fraud the market had just quickly unpriced. Same market. Same year. Wildly different accuracy. This is the 7th episode in this series, and its closing argument. It's about the conditions that separate those two outcomes, and what 6 episodes spent showing you where the machine breaks actually implies about where it doesn't. Here is what a stock price technically, mechanically is. The output of every participant in a market putting real money behind a bet about the future, continuously, all day, every trading day. Buyers who think a price is too low bid it up. Sellers, and critically short sellers who can bet against the stock as well as for it, push it back down when they think it's too high. Economist Friedrich Hayek described this kind of system as a way of aggregating information no single person, company, or government agency could ever collect on its own. Thousands of independent, self-interested judgments, compressed into a single number. Footnote 3. Here is what it is not: a poll, a vote, or an official pronouncement. Nobody has to be individually right for the aggregate to work. The mechanism only requires that mistakes be roughly random rather than systematic, that overpricing and underpricing cancel out, because enough independent capital, free to bet against a bad price, is actually doing so. Economist Eugene Fama formalized this in 1970 as the efficient markets hypothesis. Prices reflect available information, which means beating the market consistently should be close to impossible, because a profitable, exploitable pattern would get traded away the moment enough people noticed it. Footnote 4. That is not a claim that markets are always correct. It is a claim that they are correct exactly to the degree that information is available, participants are free to act on it, and nothing structurally prevents the correction from happening. That's the hinge this whole episode turns on. 6 previous episodes of this series have shown you 3 specific things that interfere with exactly those 3 conditions. Passive ownership concentrating votes without research behind them, Episode 4. Buybacks manufacturing the earnings per share number the market is supposedly pricing accurately, Episode 5. And executive pay pegged to a stock price the company itself has multiple tools to move, Episode 6. None of that is an argument that markets never work. It's a map of precisely where and how the 3 conditions efficiency requires get switched off. Short selling deserves one more sentence here because it's the part of the mechanism that does the actual correcting when a price is too high, the only tool that lets a skeptical, well-researched view push a price down before bad news becomes official. It is also, not coincidentally, the part of the mechanism most exposed to structural interference, which Section 3 gets to. Start with the fraud. 2 days before the Hindenburg report, General Motors had announced an 11% stake in the truck company, sending its stock up nearly 50%. Footnote 5. The report came out September 10th. By September 14th, the SEC had already issued subpoenas. Footnote 2. The stock slide started the same trading day the report was published, before any subpoena, before any confirmation, based entirely on an independent research firm's own investigative work and its own short position against the company it was accusing. Now the contrast. The market's reaction time on that fraud once someone actually did the work. Same day. The market's correction time on the broader dot-com bubble a generation earlier, despite the underlying economics of companies like Pets.com being knowable the entire time. The better part of 2 years from the acceleration in 1998 to the crash beginning March 2000. Same mechanism, same country, radically different speed, because one mispricing had someone specifically betting against it with real capital and real research, and the other was a sector-wide narrative nobody could profitably short all at once. Economists Andrei Schleifer and Robert Vishny gave this problem a name in 1997. The limits of arbitrage. Being right isn't the hard part of betting against a bubble. Staying solvent long enough for the market to agree with you is. Footnote 6. Then there's the aggregate case, which doesn't involve any single dramatic story at all. Over the 15 years ending December 2024, not one of the 22 tracked categories of U.S. equity funds had a majority of active, professional stock-picking managers beat their benchmark index. Footnote 7. 4 large-cap U.S. funds specifically, roughly 89.5% of active managers underperformed the S&P 500 over that same 15-year stretch. Footnote 8. Translated to human scale, of every 10 professional, credentialed fund managers who spent 2010 through 2024 trying to beat the index by picking stocks, roughly 9 of them would have done better sitting on their hands and buying the index instead. That's not evidence the market is broken. It's close to the strongest evidence available that, for the most liquid, most heavily covered securities in the world, the price is about as hard to beat as a genuinely efficient mechanism should make it. Efficiency isn't a property of the market as a single thing. It's a property of specific conditions, and this series has already spent 6 episodes cataloging exactly what switches those conditions off. Short-selling constraints are the most direct one. Betting against a bad price requires capital, patience, and the ability to actually borrow shares to sell short, and when all 3 get squeezed simultaneously, a correct bet can become financially catastrophic before it becomes profitable. January 2021 is the textbook case. Professional short sellers were substantively right about one heavily shorted retailer's underlying business, but a coordinated retail buying surge made maintaining that short so expensive that several funds were forced to close their positions at a loss, at the top, regardless of who turned out to be correct. Footnote 9. The mechanism didn't fail conceptually. It failed operationally, under a specific combination of high short interest, a thin available float, and coordinated buying pressure. The other 3 conditions are ones this series has already named in detail. Passive ownership, Episode 4, means less of the market's total capital is actually doing research-driven price discovery in the first place, especially outside the largest, most covered names. Buybacks, Episode 5, let a company mechanically improve the exact per-share metric a huge share of efficient analysis is built on, without the underlying business changing, meaning the price can be accurately reflecting a manufactured number rather than inaccurately reflecting a real one. And executive compensation pegged to stock price, Episode 6, compromises the information side of the equation at the source, before the market ever gets a chance to price anything, since the people producing a company's disclosed numbers are financially rewarded for the price those numbers produce. Put together, the market corrected a fraud in a single trading session, and needed nearly 2 years to correct a bubble, for reasons this series can now name specifically rather than gesture at generally. On October 14, 2013, the Royal Swedish Academy of Sciences awarded the Nobel Memorial Prize in Economic Sciences jointly to Eugene Fama and Robert Shiller. Footnote 10. On paper, this looks like an institution unable to make up its mind. Fama, the founder of the efficient markets hypothesis this episode has been built around, and Shiller, the economist most associated with proving markets produce exactly the kind of irrational bubbles Section 2 just described, sharing the same prize in the same year for what sounds like opposite conclusions. It wasn't a hedge. The Academy's own reasoning, published the same day, said something more precise. Stock prices are close to impossible to predict over days or weeks, Fama's finding, but show real, statistically meaningful patterns over horizons of several years, Shiller's finding. Footnote 11. Both are correct. They're just correct at different time horizons, describing different failure conditions, which is the actual, formally recognized answer to the question this episode opened with, not a compromise the committee settled on because it couldn't decide, but a description of how the mechanism actually behaves once you stop asking it to be one simple thing. Which is where 7 episodes lands. Not on an accusation that the scoreboard is rigged, and not on a defense that it's pure and clean, on the harder, more specific answer. The market is exactly as accurate as the conditions in front of it allow, and this series has spent its length showing you precisely which conditions those are, and precisely who has spent decades making sure some of them don't hold. The mechanism fits in one sentence, same as every episode before it. A price is only as honest as the conditions that produce it. Free information, willing capital on both sides of every bet, and nobody with the power to quietly change the inputs. Where those conditions hold, as they mostly did on a Thursday in September 2020, the market can outrun a fraud, a company's own denials, and a federal regulator, all in a single trading session. Where they don't, Where the votes are concentrated, the earnings are manufactured, the pay is pegged to the number itself. The scoreboard keeps score for the people who built it, exactly the way the series opened by telling you it would. 7 episodes, 1 through line. The market was never lying to you, and it was never simply true either. It was, this whole time, exactly as honest as the rules allowed it to be. Understanding which rules those are was always the actual point. This is where the series closes its case, for now. There's more machinery out there worth taking apart. When it's ready to be read the same way we will.